Welcome, everyone, to another episode of On the House with Spartan Invest. I'm really excited today. We have a special guest that's going to be discussing creative financing. He is the owner of a Creative First Mortgage. For some reason, I want to say First Creative. I don't know why, but it's Creative First Mortgage. Jason Maxam, thank you so much for joining us.
Thanks for having me.
So tell us a little bit about yourself and how you got to start Creative First Mortgage, kind of what led you there. Just tell us all of it.
Sure. Yeah. So kind of share my journey into the mortgage industry, I guess. So I kind of fell into it by accident. I think when I was 9 years old, I think I wanted to be a fireman. That didn't pan out. So I got my first real job at a finance company in about probably probably the year 2000, 99, 2000. And I was a loan officer for a subprime automotive lending company. And that's kind of where I kind of started this whole, finance world. And it turns out I really liked math. Lunch probably in school was my second favorite. But math was something I really liked. And so I fell in love with it. And then couple years later at that company, it was one of the biggest layoffs in Florida, which is where I'm from. And it was my first severance package I ever got. So I had to decide what I wanted to do. And so I did get a lot of contacts with F&I managers at dealerships. And I thought, hey, that was going to be a really good move for me. They were making six figures a year. And back then that was like $1 million for me. I think I was making $38,000 a year at my first job. So I called one of my guys and he said, hey man, I just moved into the mortgage side and it's fantastic. I said, well, hook me up. Let me talk to your boss and see how it goes. And that's kind of how I fell into it. The rest is history. And in terms of starting Creative First Mortgage, so, I've been in the business about 23 years now and I've done it all. I've done retail, I've done broker. And I think the main reason why I wanted to go on my own was I just wanted to have control over my entire business. And I'm also able to find different investors and do what we call creative loans for our customers. And you can't do that at your retail bank or at most mortgage companies. So I really wanted to have that control and be able to really offer everything to my clients that's in the market.
And there's a lot of different ways that people can offer creative financing. Tell us a little bit, or tell us how you structure your financing deals.
Sure. Yeah. So first of all, we're a full service mortgage company, meaning we do all the conventional FHA, USDA, VA, and things like that. But the cool things like that we do outside the box programs are, a lot of my self-employed borrowers, my investors, a lot of times they just don't show enough net income on their tax returns. So we can do literally a 12-month bank statement. We can use profit and loss. We also have literally a no income program that we can offer folks. And then, I guess in the last year and a half or so, I really wanted to focus on the investor side because, the numbers were saying that 1 out of 3 buyers were first-time home buyers. Like there's just not a big market. I guess we can probably talk about that down the road. But I really wanted to focus on some of the programs that I can help investors with because I'm an investor myself. And I know how hard it is sometimes to get into a loan where you're not showing enough income or, you don't have enough experience. Maybe you're doing your first fix and flip, or you want to buy your first rental. So we really focused on bringing on a lot of investors that allowed us to expand our portfolio.
So how do you help? What are the most common creative financing options that you do offer to investor clients? Obviously, that's our main listener, those looking to purchase rental property or get into the space in general, learn a little bit more about real estate investing. And I think especially those that if you don't have, if you're not an employee, you don't have a W-2, it can be hard to go that traditional route. And so being able to speak to somebody like you, get some different options, I'd love to hear what the most common one is.
Yeah, so the most common one right now is what's called the DSCR loan. It stands for debt service coverage ratio. And we basically qualify the person on the income of the property rather than the income of the borrower. So in other words, if you've got, 20% down and you want to buy a house, but you can't show any income, you don't have to show any income on these type loans. So you basically just take the rent from that home, and as long as it covers your mortgage, you're generally approved with good credit and even not so good credit. We've got a lot of different creative ways, and talking to your audience directly, a lot of them may know about fix and flip loans, but we also have these DSCR loans where you can put less than 20% down in some cases. We can borrow against houses that are still vacant. We also have some commercial finance options. And then to go back to the fix and flip loan, obviously that's great for someone who's looking to get in, fix it up, and make a profit and get out. So we have those bridge loans or those short-term loans to allow folks to leverage that money, not use all the money in the deal, so where they can get in, get out, and make a profit.
Big elephant in the room. We're recording this in May of 25. I'm not 100% sure exactly when it's going to air, but that's when we're recording, with interest rates still elevated. Not exactly sure when they're coming down. How are you working with investors or just your clients in general on still being able to afford rental property or home ownership in general?
Yeah, so that's a great question. We get that a lot. And really, it just comes down to affordability, right? There was a saying that everyone was talking about when rates were like over 6%. It was the first time we've seen that in a long time. And a lot of realtors and a lot of my colleagues would say, hey, marry the house, date the rate.
Yeah.
Well, now rates are at 7. So like, what are we saying now about that? And so I think what's the most important thing for, especially first-time home buyers or someone that's buying their primary home is, let's not rely on what you think rates are going to be at, because I think everybody thought that rates are going to come down by now.
Right.
And it just hasn't happened. It's not the case yet. Matter of fact, the U.S. credit rating, Moody's just rated the U.S. and they downgraded us. We had a 20-year bond auction today and it went horrible. We didn't get the buyers that we wanted. We had a really bad day. So now the 10 years back up at 4.6%. It's the highest it's been since January. So I think there's going to be some, a little bit longer time for these elevated interest rates. So, we can always talk about refinancing, and I always like to coach my clients about doing that when the time is right. But what we don't want to do is get someone into a house where all they're doing is working to pay their mortgage. So it's really critical in the beginning to talk about what their goals are, what their family can afford. And, going back to the investor side, it's kind of the same thing, but it just comes back to maybe not so much affordability, but really cash flow.
Mm-hmm.
So if you're not cash flowing on a property, there's properties now that they just don't cash flow. They don't make sense. And so there is a limitation on, what you can do for an investor in some cases. But again, there's some options that we have that we can creatively do, such as interest-only payments. We could also do 40-year terms. So if you're just looking at cash flow, those can be some options for investors. So I think it's just important to understand what your goals are, what you can afford, and or what your cash flow looks like.
Absolutely. And, we've been in this environment for a few years now, and, everybody trying to predict when rates will come down. But I've heard that a lot is, hey, you date the rate, you marry the house. And
Yep.
And again, hey, if you would have bought when it was 6, you're in a better position now. So don't necessarily wait to buy real estate. But on the investor side, if the numbers make sense, it doesn't matter what the interest rate is. And that's kind of what we
Right.
always preach, is that if you're able to cash flow, if you're able to generate a decent rate of return at a 10% interest rate, what does it matter? If the numbers
Right.
work. And I know that you know this. I'm sure a majority of our listeners know this, that as soon as rates come down, prices elevate. And then we're seeing, hey, prices are starting to come down. It's just not as competitive as a market because rates have been pushed up. So it's becoming more of a buyer's market. And that's going to help your overall rate of return, et cetera, et cetera. And then affordability, more people are having to rent. So demand for rental properties has gone up. So all of that is going to help your investor, but it's, again, you don't want to miss out on the opportunity just because the rate is high if the deal makes sense. And same,
Sure,
like you
and
said,
then
with affordability with owner occupants.
Right. And then you can look at midterm rentals, Airbnb rentals. So you can elevate that rent. So again, going back to just what are your goals? What are you looking for? And you're absolutely right. I don't care about rate. If someone's paying my mortgage, if I'm an investor, I don't really care as long as I'm cash flowing and
Right.
someone's paying that interest. I just get a higher deduction on my tax return. So
Yeah,
if you do it in a strategic way, I think you can make a lot of deals make sense.
absolutely. Absolutely. So talk just very briefly on the 40-year option. That's interesting. Tell me a little bit about that.
Yeah, so most people that qualify for a 30 can get a 40. There's been some talk about how we shouldn't do that. Maybe it's too long. Well, I mean, 30 years is pretty long too, right?
Right.
So all it does is over the life of the amortization, it just gives us a little bit lower of a payment, so you can make those maybe tighter deals work out some. And the same goes for the interest only payments. I probably personally would like to do a 40-year over that because you're not paying down any principal. And even though most of your payments are going to go towards interest in the beginning, it is nice to knock some of that principal down over time
Mm-hmm.
because you really never know how long you're going to be in that loan. A lot of folks, they say, well, I'm only going to be in it for 6 months or a year. Well, sometimes you're in it for 3 years, 4 years. So, you want to look at your short-term and long-term goals before making that decision. And we always like to do a side-by-side comparison, break it down and see what makes sense for each person.
Gotcha. Gotcha.
Yep.
Uh, you had said that most of your buyers are investors. Is that been a recent swap? You've said the was it 1 out of 3
Well,
or home
so the
buyers?
market, yeah. So I guess those are that's data from other sources. We have a good mix of both. I would say right now we're probably 50-50. So, we get 50% investors, 50% primary or second home
Okay.
buyers. Yeah.
Gotcha. Well,
Mhm.
most of our investors, they're out of state investors and they're attracted to markets like Alabama and Tennessee and Georgia. How would you approach lending for those out of state investors? Are there any challenges that they would see compared to local buyers?
For us, not really. There's not a ton of more challenges. The approval is going to go the same way, but I think I think sometimes the challenge is the investor really understanding the area that they're buying in, right? So if they don't know the area, if they don't live here, I can go online and say, wow, I just found this $6,000 home in Birmingham. I can't believe they're still selling it for that. Well, it could be, someone could have got shot there. like there's some bad areas in Birmingham. And so I think
Absolutely.
that could be
Absolutely.
some of the challenges for that. But I don't know. I guess maybe another challenge is that if they're not local, they really can't see homes in person. So I think it's important to have a real estate agent that is, comfortable working with investors that can maybe do a FaceTime, going
Mm-hmm.
through the house, maybe having someone kind of boots on the ground, so to speak. I think that would probably be the biggest challenge for the buyer. But for us, I mean, we're licensed in 6 states, but we also do lending in almost all 50 states with investment loans because we don't necessarily need licenses for every state to do investment properties. So yeah, we can help that. Well, we can help most buyers in that regard.
Okay.
Yeah.
Advice for those investors. Say you're more primarily on the financing side, not necessarily on the buying side. Absolutely, yes. If you're trying to buy out of state, please partner with someone and get as much information.
Yeah.
You need a boots on the ground. Do not rely on AI. Don't rely on Zillow. Always seek the advice of your local professionals. I think that's great. That's a great advice to give them. But what other advice would you give investors that are interested in kind of the turnkey market in today's real estate market?
There's a couple companies out there. There's this company called Spartan Invest that I think does a pretty good job turnkey. But yeah, I think just, getting specific to what you're looking for and who you want to work with, I think is really, really important. So, I'm always the guy, I'm a networker. So I always tell people, look, if it's anything real estate related, call me. I know a guy or a gal.
Mm-hmm.
Yeah, it's always good to know who is focusing on specific, types of investment deals. So like, for example, I know you do a lot of turnkey homes. you're a perfect fit for a lot of investors that are out of state because they don't want to do the legwork. They don't have the contractors here. They want someone that can go in with and have a house ready to go. And then, of course, I've got subcontractors that I've used over the years. My wife actually owns a commercial construction company, so we know a ton of subcontractors that do finishing, drywall, and things like that. That will a lot of times recommend when needed. So I think that's how we can help them.
Yeah, I've heard you talk about that at your wife's
Yeah.
company and what you do, and you guys have rental property as well, and you kind of do some creative methods with your rental properties. Could you tell us a little bit about that?
Well, not to give out all of my
Okay,
secrets,
you don't have
but
to.
no, I'm kidding. So honestly, so one of the things I've done here recently because of the elevated rate environment, and I've done a lot of subject to purchases. And for those of you who don't know how those work, it's basically, you're committing to take over payments for a seller that for whatever reason can't sell their home. So we come in, usually pay, a fee to either the realtor that brings it to us and or the seller to have them move out or for whatever they need. We essentially assume that payment and then I resell it to another buyer. And the reason why this works really well is because there's a lot of mortgages out there that are at 3%, 4%, right? 5%. And so it makes a lot more sense on a cash flow basis for someone that's moving that doesn't want to deal with the house or just can't sell it. Or maybe there's just not enough room in that deal for a realtor to make a commission on.
Mm-hmm.
So I would pay for example, I did one where I had an elderly woman that I closed her mortgage probably 6 or 7 years prior to our transaction. She had a cash buyer that was going to buy her house. So she was moving out of state with her daughter. Well, long story short, she moved out, got all her stuff out. A day before closing, the cash investor said, "Hey, sorry, we're not buying it." So she was literally homeless, living in, one of those, what are those little short-term hotels? I forget what they're called.
Yeah,
Where you
extended
can
stays
do
or
by the
something
day
like
or by
that.
the week. Yeah,
Mm-hmm.
something like that. And she was in a bad spot. So one of my realtor friends called me and said, "Hey man, are you still doing those sub-2 purchases?" I said, "Absolutely. What do you have?" So I was able, in 2 days to pay her almost everything that she was going to make on the sale of her home. I had to squeeze the realtor for, their commissions, but they understood.
Right.
So we were able to pay him a nice fee. And then I sold it a week later to a customer that we couldn't get formally approved, but because she couldn't show any income, her credit wasn't there, but she had a bunch of money to put down. And so we were able to not only recoup what we had paid out to the seller and the realtor, we were able to collect that and more, almost $10,000 more. And that one's cash flowing for about $680 a month. So what I'm doing now is I've been able to kind of be the in-between person for a couple reasons. I like to service the loan to make sure that the seller gets their payment. And then I get to, service the buyer and make sure that they're making their payment. Because if they don't, I can still make the seller's payments without having any issue and then maybe resell it to someone else. But haven't had to do that so far for sub-2s. I closed 4 of them last year and they've all been performing pretty well.
Yeah, that's really interesting. And again, that's just a great example of all of the different options that are out there to start buying real estate. It doesn't you don't have to have a real estate agent to go find something on the MLS and you do renovations to it, et cetera, et cetera. There's multiple different options.
That's right. And then just to add to that, so for someone, maybe a new investor that finds a deal like this, I got this deal with no credit, literally no money, because I could have done a short-term, loan that I paid back right away with a down payment. And now I'm just collecting cash flow. So there are absolutely great creative ways that you can get into this market without necessarily having to go through the motions of getting approved with a traditional bank.
Yes, absolutely. Because you've got your 10 conventional that you can do. And a lot of times when investors, when they've hit that 10, they're like, okay, well, what do I do now? What are some different options? With rates what they are, a lot of people are talking about your adjustable rate mortgages. What are your thoughts on these options?
Yeah, so we haven't really seen a huge difference yet. Not to get too technical, but there was what's called a yield curve inversion, where basically the 10-year flipped the 2-year. And basically all that means is that, so if you are borrowing money or or saving money rather, you would actually make more money interest wise on 2 year than you were on a 10 year. So there was this yield curve inversion, and we'll find some 5 and 7 year arms that could work, but most of the time it's not a significant difference. Maybe an eighth of a point or so, to go to regular 30 years. So, right now there's not a huge opportunity for arms. They don't really make a lot of sense right now in this market environment.
So with over 20 years of lending experience, what would you say have been the most significant changes that you've observed in the mortgage landscape?
Yeah, great question. So I think the biggest change that we saw was back in 2008 during the housing crisis. Before then it was kind of like the wild, wild west, and there was a lot less regulation and oversight. And once that occurred, really what it was for was to curb mortgage fraud. But after looking at the data, it really didn't do that. So I'm a little bit excited for kind of that a little bit of deregulation in our industry, because what it really did is it really raised the costs for not only buyers but for mortgage owners as well. And the reason why is because we have to go through an appraisal management company. We have to have employees here for compliance, and what it did for me personally, or I wouldn't say personally, but like for most loan officers, it really kind of split our job into two parts. So one person had to go get the business, but then the other person has to manage the business because the intricacies and the paperwork and all that has to be done. So, since that happened, appraisals have doubled. Title companies are charging more because they have to do their due diligence and compliance. We had to hire more people. So it really did hurt the consumer more, and mortgage fraud really didn't change much. So I think the increase of cost and the overregulation in our industry was really probably one of the biggest changes that I've seen in the industry. So yeah, I'm going with that.
Yeah, no, that's a really good example. And again, it's like everything, we overcorrect. Like you said, prior to, it was the wild, wild west, and that everybody was approved. And then we just overcorrected. And now it's too regulated to where it does hurt the end owner occupant. And that's if housing becomes unaffordable, then, kind of what's the point? It trickles down. It makes rental properties, not ideal because you can't generate a good rate of return, cash flow, et cetera, et cetera. So, I think that's a really good example. Currently, would you say that there's any specific programs or incentives that you think are being underutilized right now, but might be worth investors exploring?
Yeah, I think for investors and, first-time homebuyers, there's a couple good things. I think we touched on some of the investor stuff. So I'll start with with the primary, maybe first-time homebuyer, right? So we have like the low to no down payment program, where you do a house counseling. You get a certificate, takes about 45 minutes to an hour, and that qualifies you to do 3% down with very low MI. We also have some low to moderate income borrowers that get some breaks on some programs that we have. There's also what a lot of people aren't talking about is the buy down program. So we have what's called a 1-to-1 buy down, a 2-to-1 buy down, or a 3-to-1 buy down that I'm sure you're familiar with.
Yeah.
But essentially, while we're negotiating, if the seller can actually help to pay down your interest rate. So, if interest rates are 7, which they're probably teetering around that today, if the seller's willing to pay for a portion of your closing costs, we can use that to pay down your interest rate. So you can start literally with a 4% interest rate year one, then it goes up to 5 year 2, so forth and so on up to 7. And I think that's a really, really good product that's being underutilized right now, just because a lot of people don't think about it, or maybe realtors aren't familiar with it. So we really like to coach our realtors and our buyers on those types of situations. Now, you still have to qualify for the standard rate, but I really like this program because, like you said, we don't know when rates are going to come down. We're certainly at a topping point, but I think if you get a 4, 5, 6%, by the time we're ready to refinance, we've already kind of taken advantage of those low interests. And then when it's time to lock into maybe a forever rate or a better rate, we have a really, really good opportunity to do that for our clients. The last thing I'll say about the investor programs that maybe we haven't touched on is, so I also own a small private lending company. And so if things make sense, we can lend private capital out to customers that may need it for short-term lending. We'll go up to 1 year, and we can talk more about that, or I can probably have my information somewhere on this podcast. But essentially what we're doing is, if we're at a 50% or less LTV, or you need some short-term money, we can also help there. Guidelines, it's really more common sense guidelines. My partner and I have been both doing this collectively for almost 50 years together. And so we'll self underwrite these files, and then we loan our own money out for borrowers that need it.
The 3-2-1 program, I agree. I think that is ideal situation when you're talking, when you're a first time home buyer and rates are where we feel like it is at the highest point. Or one of the highest points. It's definitely the highest that we've seen in decades. So it allows them to take advantage of a lower rate. Now, question, if the 3-2-1, if the rate, let's say they lock in, they buy today at a 3-2-1 and the market crashes, we go into heavy recession, Fed cuts the rates in 6 months. Are they able to go ahead and refi and eliminate that 3-2-1, or how does that work?
Yeah, so our minimum is 6 months of payments. There is no prepayment penalty for those deals, because the seller's already paid for that additional interest. So what they're basically doing is they're taking what the bank is essentially losing on the interest, and whatever the difference is between the rate and the current rate, the seller's already paid for. So there's no prepayment penalty to pay those off. But for us, we need the customer to make at least 6 months of payments before refinance.
So at the end of the 6 months, they can do the refi, get the lower rate. And then what if there's a difference between what the seller paid, like I guess left over, if the seller paid for the 3 years of the buy down?
Yeah, so that's already kind of baked into the scenario. So there's nothing you can do in that route. But on a 3-2-1 buy down, I would be absolutely shocked if interest rates went 3 percentage points down, in the first year. I don't think
that's not going to happen.
probably not going to happen, at least historically. I mean, like as fast as we ramped up, like the increase in rates when the Feds were doing that, rates still kind of climbed at a slow pace. And I think we did, I don't know how many, 12 or 13, something like that.
Hikes over
so I wouldn't expect, I wouldn't expect that to be a big issue. However, we're ready to refinance whenever there's a good opportunity and it makes sense for the client. And we'll always take a look at that and see.
Awesome. Well, Jason, thank you so much. Any other last words that you want to leave with investors or owner occupants looking to buy?
So I would just say, before navigating the market, it's really, really important, whether it's me or somebody else, you got to know where you stand on your finances. So, make sure you, again, go over your affordability, make sure you're qualified, make sure you're looking in the right price points, and know what your goals are, especially as an investor. You got to know, if you're going to rent it, if you're going to flip it, all these things matter because it changes your approval. And some people that are approved for a DSCR loan may not qualify for a fix and flip loan. So I think it's very, very important to get with a local lender, local being probably the most important thing in that sentence. Someone that knows the area, make sure that you're going over those numbers and making sure the affordability is there for you.
Absolutely. Well, thank you so much, Jason, for joining us. And if they do want to get a hold of you, what's the best possible way?
Yeah, easiest way, just go to my website, jasonmaxam.com. And from there, you can book a call with me. You can fill out an application. You can contact me very, very easily. And I'm available pretty much 24/7. So I don't get to you right away. I get to you the very, very next day. And we just have an incredible team behind me. They make me look way better than I think I am. So I'm very grateful to have a great team behind me that makes us look good and helps as many, many clients as we can.
Well, thanks again for joining us today. And that's On the House with Spartan Invest.
Thank you.